Coming up on Market to Market. Old Man Winter flexes his muscles as another blast of Arctic air and heavy snow extends from Colorado to the East Coast. And the Agriculture Department offers a cautiously optimistic outlook for farmers and ranchers in the months ahead. Those stories and market analysis with Don Rose next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, February 27 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Demand for long-lasting manufactured goods rebounded in January in the wake of back-to-back monthly declines. Orders for durable goods increased 2.8% last month in their biggest gain since July. The move was paced by a 129% surge in demand for commercial aircraft. Excluding the volatile transportation sector, however, orders increased a more modest 0.3%. Demand for capital goods, a barometer of business spending intentions, rose 0.6% in January after 4 consecutive months of decline. And bitterly cold temperatures in the east have fueled a spike of nearly 20% this month in heating oil prices. Winter has been especially tough on much of the U.S. this year. And this week, another round of heavy snow and Arctic air extended from the shores of Maine all the way to the Rocky Mountains.
Starting in the west, snow fell by the foot on Colorado. Forecasters predicted more than 2 feet of new snow for mountain areas and the western slopes of the Front Range. In the deep south, almost a foot of snow blanketed Alabama, and some records dating back to the 1890s could be broken in the first blast of wintry weather. Thousands were without power as freezing rain snapped utility lines. Much of the ice melted quickly, but lingering cold weather could hamper cleanup efforts. The same system also dumped nearly 9 inches of snow on parts of Georgia. Other travel was not recommended as local officials warned of the dreaded black ice. 2 different storm systems blasted North Carolina. Cleanup was widespread late this week following the most recent snow, sleet, and freezing rainstorm. More than 8 inches fell in the mountain region of the Tar Heel State, and nearly 200,000 people were left without power. As the South wrestles with snow and ice storms, much of the Corn Belt and East Coast is locked in a deep freeze. Sub-zero temperatures are forecast for days, and February of 2015 is on pace to be the coldest on record in many Midwest and Northeastern cities. At least 2 feet of snow blanket 7 northeastern states. Across the Midwest, less snow is found in areas west of the Missouri River, according to this snow depth map from Intellicast. But the latest drought monitor from the University of Nebraska reveals some areas are still in dire need of moisture. California remains locked in severe drought, and new pockets of exceptional arid conditions have widened in Oklahoma and Texas. Nationally, more than 50% of America is in some form of drought, the most widespread in more than a year.
It appears that California will be heading into a 4th year of drought. There's a couple of reasons for that. One is that we have not built up the snowpack in the Sierra Nevada, which is a key watershed area for California. We won't pick up much more moisture into the reservoirs, and as a result, we think that some of the water cutbacks for 2015 could be as serious as we saw in 2014, when more than 10% of the agricultural land was left fallow due to water restrictions.
Torrential rains in Northern California in recent weeks have done little to ease the state's prolonged dry spell. But the drought has prompted thieves to steal one of the state's more precious commodities, water. In one of the more unusual cases, officials say bandits removed irrigation pipes in the Silicon Valley so a nudist colony could make unauthorized diversions from a waterfall. While arid conditions have eased considerably in many regions further east, the Agriculture Department acknowledges that drought still could be an issue this year. Nevertheless, USDA officials are cautiously optimistic about the outlook for farmers and ranchers in the months ahead.
We can see here that the drought situation for many parts of the U.S. outside California has improved. That will improve the outlook for pasture and cattle in the southern plains as well as winter wheat. However, the severe drought in California has not improved from last year and continues to affect production.
While the impact of persistent drought was mentioned as a potential challenge, the outlook was generally positive late last week for USDA's 91st annual Agricultural Outlook Forum.
It's a year for us to talk about the importance of agricultural trade. I mean, the reality is agricultural trade is responsible for 30% of all gross ag sales. 30%, that's roughly equivalent to net cash farm income from year to year. So if you take exports out of the equation, it would be very difficult for many producers to stay in business.
And though officials admit that U.S. producers will face pressure from South American soybean growers and wheat farmers in Europe, the prediction for 2015 favors global market expansion.
While ag trade has become increasingly competitive, the resolution of old trade disputes and prospects for new agreements promise to open new opportunities to U.S. producers.
As the details of trade agreements with Asian nations are also worked out, U.S. and European Union officials iron out creases in the Transatlantic Trade and Investment Partnership. But one domestic trade group sees EU policies on geographical indicators, or GIs, as a roadblock. According to the World Trade Organization, GIs are place names that identify, among other characteristics, the origin and quality of agricultural products. The U.S. Dairy Export Council expressed concerns over restrictions on such cheese names as Feta and Asiago, which it views as long-standing generic food names. The group noted $21 billion in U.S. cheese production uses European origin names. And if EU policy were to be included in the trade agreement, third country export markets could be off limits for some American-made dairy products. Stumbling blocks aside, the U.S. and EU have enjoyed comparable agricultural trade surpluses in recent years. And Vilsack's European counterpart said the two trade behemoths are really shoulder to shoulder in the global marketplace.
The moment, in my view, is now ripe to create a trade superhighway across the Atlantic, built also upon the experience of existing free trade agreements with other partners. The EU-US trade relationship is already the biggest in the world, accounting every day for more than €2 billion of trade in goods and services.
Next, the market-to-market report.
Wheat futures contracts posted modest gains this week, while corn traded sideways again. For the week, May wheat gained 6 cents, while the nearby corn contract moved fractionally higher. Soybeans broke through the $10 barrier as the May contract advanced by 30 cents. Nearby meal prices followed suit with an upward move of $3.80 per ton. In the softs, cotton kept its head above water as the May contract improved by 20 cents per hundredweight. Over in the dairy parlor, Class 3 milk futures gained 17 cents, while the deferred contract moved 48 cents higher. Livestock prices recovered some of their recent losses as the April cattle contract gained $3.18. Nearby feeders advanced by nearly $2, and the April lean hog contract eked out a gain of 7 cents. In the currency market, the euro lost 16 basis points against the dollar. Crude oil declined by just over $1 per barrel. COMEX gold advanced by $8.20 per ounce, and the Goldman Sachs Commodity Index gained more than 3 points to settle at $419.50. Here now to lend us his insight on these and other trends is one of our regular market analysts, Don Rose. Don, welcome back.
Thank you, Mike.
We're glad to have you here. I want to jump right into this wheat market. We've seen stagnation in this market and a downward trend. This week, looks like we're holding steady. Do you think we've found some stability here at these prices?
Well, you know, really what happened with the wheat market, Mike, is we just plain got oversold. And then the funds pushed into the market too aggressively on the short side. Then a little bit of nervousness with some of the cold weather that came in. But I think really the problem is when the wheat market pushes up to some tough resistance areas, you know, July wheat 540, 550, we just become, you know, we're not there now, we're about 517, but up at those areas we just become real uncompetitive, and there's a lot of wheat in the world market. Europe particularly selling wheat aggressively below us by about 20 cents a bushel, so we can't go too fast to the upside too quickly.
Well, now that being said, a lot of producers would like to sell at that 550 level there in July, and we've got a question here from one of our viewers on Twitter. He found us at Market to Market on Twitter, and it was Jeff in Kennedy, Minnesota. And speaking of the cold weather, we saw that in telecast map, not a lot of snow cover on that winter wheat ground throughout the plains. And his question was, is this cold weather causing any concerns yet for the winter wheat market?
Well, I think that's it. I think what we're doing is trying to add some risk premium to the market. Of course, soybeans moving up to the upside really was the leader on everything and caused people to move around. But the cold temperatures certainly are an issue, and I think what's going to happen in the Ukraine area is also an issue. So, yeah, I mean, it's that time of year where we've got some nervous questions going on.
Now, give us a quick update, if you would, on the Ukraine situation. There's been a lot of uncertainty with Putin and whether or not they'll allow exports. What does the market anticipate today as we sit here this week?
Well, so far it's been uninterrupted. There's no big issue. But I mean, Putin, the fear is that there's a couple big ports, one particularly that Ukraine controls that, you know, could be an issue. And, you know, that's what the trade's really watching to see if the Russian people, the government's going to move in and try to work with those ports.
All right. Well, let's jump down into the corn market. We haven't yet seen the big export news that I think a lot of folks were hoping for on this old crop corn. Do you feel like we're going to get that as we look here in the next couple weeks?
Well, the problem with the export market right now in the corn market is we're overpriced compared to the rest of the world. Argentina and Ukrainian wheat are both about 20 cents a bushel cheaper than we are. So, you know, again this week, you know, when you try to move to the upside, it's just a real struggle. We don't have a new demand story. Our export pace is, you know, probably is just okay. It's certainly not a soybean export pace, but there's really no huge optimism on exports or new domestic demand. And that's why we're really caught here, and we're really looking forward to what could happen with the spring and the acres. And we're just really on hold. And you can see we've been treading water, you know, for a long time on the corn market. We've got a head and shoulders pattern that we just can't break out of.
Now, looking at this old crop corn in particular, a lot of producers, that $4 mark on the board is something they'd like to see. Is that something we might have a chance to catch here?
Well, what we really are at is just a trading environment. We think between $3.60, $65 on the downside on corn and $4 on the upside for 05. But it's really the carries in the market. You've got March corn at about $3.85, just under $3.85. You've got July just over $4. So if we march through time, the carries come out of the market and we move lower. So I think we stay in this trading range until we can come up with some new news, and it's probably going to be the acres or the weather that's going to move us out of this. But rallies are meant to be sold, Mike, in a supply bear market.
Rallies are meant to be sold, and with that decent carry in the market, would that be the appropriate marketing strategy? Look to sell out there in the future and capture some of that?
Well, I think you do have to try and take advantage of the carry in the market, but make sure that you also keep an eye on the basis, because there's a lot of old crop corn that has to move. And by the way, these rallies, particularly in soybeans, but also in corn, are bringing out more movement, not just in the U.S., but in South America also.
All right. Now, on the new crop corn side, we've heard a lot of talk of fewer acres. And I know we're not quite into that decision-making time yet, but if we do end up with that 86 million corn acres, would there be room to the upside at current demand levels?
Well, that's the fear right now, is that you don't reach this 89 million acres, that it could be lower than that, 86 million, 87 million. And then I think the other question is, what's the yield going to be? The government's using the second highest yield on record. You know, is that going to be a possibility? And then with the high input cost, are the producers going to take care of the crop like they did last year and, you know, put adequate fertilizer on and such? So there's a lot of questions on the acres, on what the yield could be, and of course what the weather's going to be. But we have the potential to go either way on the corn. It looks like we're going to be supported, you know, 20, 30 cent breaks. You're going to get a lot of support just because of those uncertainties. But rallies to the upside, you know, 430, 440 on D's corn, you know, certainly if we get a crop, are lofty levels.
All right. Now let's jump down into soybeans, kind of the Cinderella story of the past couple weeks, particularly in old crop beans, as we're up 30 cents on the week. Is this strength all related to that truckers' strike in Brazil, or are there other factors at play here?
Well, we think that's the main issue. And, you know, the soybean market just continues to be, like you say, the Cinderella. It keeps getting bailed out when it's ready to roll over. But we think probably that trucker strike, we probably have 50 to 80 cents of premium in the market for the strike. So when you look at it over the weekend, if that starts to ease back, you know, we could come under some pressure again. Fundamentals haven't changed a bit. It's just that we maybe have slowed down the movement, maybe not. We think there's still adequate supplies at the port for another 4 to 6 days. And we think that as of Friday, late Friday, the strike was starting to ease. So next week is going to be an interesting one to see if we take premium back out of the market. But harvest continues to be pretty brisk, and we haven't picked up poor yields yet.
Now, one of the topics that was being discussed here towards the end of this last week was that there was the chance for widespread rains in Brazil next week, potentially slowing harvest. Any weather premium in this old crop bean market today due to that kind of a risk?
Well, we have had, you know, some delays in the harvest, but at the same time, the northern states were starting to reach about 50–55% harvested, so we're moving along pretty aggressively. It's maybe slowed down the planting on the second crop, the safrinha crop of corn. You know, that's probably an issue also that we're keeping an eye on, since the world supplies on corn. You know, production next year is going to be down in the world about 2 billion bushels, down from 37 billion production in the world down to 35 billion. So, you know, the soybean market, we think, is one that probably has the most potential to downside once we resolve some of these issues.
Now, that being said, as we look at this new crop situation, still up 30 cents this week, almost. Time to get in there and make some sales on this November bean?
When you approach $10 on soybeans, when you're working with a carryout that the government has 430 million carryout for next year, and that one could easily rise, Mike. I mean, if the yield goes up, if the acres go up, you could easily be up at 550 to 600 million on a carryout, and that's a negative number. If you look at the price that the government's using for next year is $9, and they're using a corn-bean ratio that's out of whack, you know, with corn at 350. So, you know, you have a chance for, if it looks like we're going to have a crop, to take the November beans down close to $8. So we think that there's weather premium, strike premium in the market, and the market is an overachiever on soybeans at the present time.
And when it gives you a premium, kind of nice to clip those coupons and stick them in your pocket. Let's jump down and talk about this cotton market. Don, we're up 27 cents this week. This cotton market, again, kind of like soybeans, a weird Cinderella story. We've been on a nice little climb here these past couple weeks. Does it look like that has the strength to continue?
The cotton market is very similar to the soybean market. We, you know, we're under 60 cents on cotton. We kind of stabilized about the same time the soybeans did. We pushed to the upside. A little bit of talk about reduced acres maybe in the cotton. But fundamentally, it's very similar to the soybeans. It's a supply bear market. China is holding most of the cards. They have a big carryout, a lot of stocks, and it's just a matter of if they start to push those stocks to the market, you know, the market stalls out quickly. So I would call a lot of technical and fun buying in the market similar to the soybeans, and that's why we're up at these levels. But the market should stall out and start to drift back under 60 cents again as we go into the fall.
Looking out into the future towards fall, is there support down in the mid-50s that we could hang our hats on as hope, or does it look like it could just trend down into the 40s at some point?
No, I think on the cotton, I think you're really talking a market is a 50-55. I think when you get down into some of those lower levels, it would be a panic selling type of stuff, and I just don't see that right now in a storable commodity. But again, a lot of it's up to what the Chinese plan on doing with their big cotton supply.
All right. Well, let's jump into the livestock market. We saw the cash cattle contract, fat cattle, climb up $3 this week. Was there much fat cattle cash trade on the week this week, or was the activity mainly on the board?
Well, the cash cattle market continues to just kind of stall out here around this 159 to 160 area. But, you know, really what happened to the futures market, Mike, is we were too oversold. April cattle sitting went down this week, made new lows, went down close to 145. But when you look at cash cattle trading, you know, up substantially higher, the normal basis levels this time of year is for April futures to be $1 over cash. So when you're sitting $7 to $8 to $9 under, the basis is just distorted. It's an excellent opportunity for hedgers to sell the cash and buy back your position. But and then we saw the box beef picked up a little bit to the upside, but When you look at prices on April cattle, 155 is a tough resistance area. 160 looks like, with all the competing meats that we have out here, is going to be an area that's going to be very difficult to get through.
Now, as you talk about the box beef climb a little bit, and you mentioned all the competing meats we've got out there, this rise in box beef, was that attributable to an increase in demand on the consumer side, or were folks just looking to kind of refill coolers and restock? What do you think was driving it this week?
I think the big thing was the production was down just a little bit, and I think it's kind of a combination of everything. With the East Coast problems, I don't think the demand was really that strong. So I think you have to say that you have to be a little bit careful on this this rally, really. I mean, the box beef was up $7, $8 this week. But the overall weights, Mike, are an issue. They're adding about 2.5% to the overall slaughter. So the strong dollar is causing some imports to come in faster than they should. So there's a lot of things that have really filled in the holes of really a terrifically bull market. But I think it's a mature market at the present time. Rally's meant to be sold.
All right, we found some resistance. Now, as we jump down into the feeder cattle market, again, we saw a little rise on the board. Cash trade still well above futures price. Does it look like we could climb to meet that here anytime soon?
Very similar to the cattle market. You know, we had the funds just too aggressively on the long side of the fats and the feeder cattle, and so, you know, they're continuing to liquidate. I think the trade feels that the market is mature, but it's a market that the feeder cattle market's really caught. I think if you get up to 210 to 220 on the nearby feeders, it's going to be a tough resistance point. You get down into that, you know, 190 area, pretty good support, and I think that's going to kind of catch the range. Then we're going to look at what the feed values do on the to really give us further direction on the feeder cattle.
Now, looking out longer term, particularly in the feeder cattle contract, I was in southern Iowa this week talking to a group of cattlemen, a lot of cow-calf producers, and they were worried about the very thin trade that we see in Chicago on the feeder cattle market, and they wondered if it was still a useful tool for risk management. Do you feel that it is a useful tool still out there for cattlemen?
Oh, most definitely. If it's a useful tool, and probably the advantage that you have on the feeder cattle is it's a cash settlement. So you don't have to deliver feeder cattle. So, you know, once you establish you're a hedge position, you're comfortable with it, it'll match up for you against the board, and you don't have to have another transaction. So I think it's a good, useful market, and something I would encourage everybody to look at and use, and maybe the volume would pick up more.
Right. All right, well, now let's jump down into the hog market. You mentioned competing meats. We've seen hog prices come down fairly substantially here over the past 3 weeks, and it looks like we maybe found a bottom on the board. Don, what do you think?
Well, the hog market's been searching for a bottom for most of the winter, and it's just that the cutout just keeps kind of coming under pressure. And, you know, there again this week, you know, we were down another $2.5, $3 on the cutout, so we're still struggling. But what the hog market did do is it's starting to dial in a lot of the negative news. Rallies are meant to be sold over there. I mean, in the latest production week, pork production was up 9.3% versus a year ago. Slaughter the last 4 weeks has been up 5 to 7% versus a year ago. The USDA report says we're supposed to be up 1 to 2%. So that's the problem with the hog market. There's just too much meat. And then the imports, we're having imports of pork bigger than they should. The exports are slow. They're under 20%. At our highs, we're up over 25%. Call it the West Pork Strike, but some of it. But I think it's just plain demand. We have to absorb too much meat into the market here.
All right, so we'll have to watch that play out slowly, maybe over the next couple months.
Yeah, I think, you know, that's going to be the real issue, that we're just going to have to watch the demand to see if we can absorb the supply.
All right. Well, thanks for being with us this week, Don.
Thank you, Mike.
That wraps up this edition of Market to Market. But you can find expanded market analysis as well as streaming video of our program, all free, at our Market to Market website. Now, we want to remind you that Market to Market may be airing in some different time slots in the days ahead due to PBS fundraising activities. So if you value Market to Market, please consider phoning in a pledge to invest in a service providing you with accurate information and timely market analysis. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.